John Taylor of Liberty Corporate Benefits, welcome again to this episode of Living Markets with Liberty. How are you, John?
I'm good, and yourself, Leon?
Very well, thank you. John, I've had a bit of a rough week. Okay, so
Yeah.
I've been looking forward to this interview all week, and I happened to notice something on your WhatsApp profile or something when I was paging through things the other day, and it looks like you're an Arsenal fan.
Indeed.
Now, that's problematic for me because, as you can see, I'm proudly Man United since birth, and you're leading the table.
Yes.
And I'm not leading the table. I'm very much midway through the table. The only thing that's giving me any kind of happiness is the fact that Liverpool, who won the league last year, are behind Man United. But it's not pleasing that Arsenal are sitting at the top, because Arsenal have been struggling to win the title for an awfully long time, and I've taken a lot of pleasure out of that, if I'm honest with you.
21 years is the length of time. Yeah.
Exactly. I really, really like that number, and may it continue. John, why am I talking about football? I think there's a lot of commonalities when you look at any discipline in life, and football is the one I'm focusing on today, and investing, the topic of this podcast. And I was thinking about it earlier. You're sitting in a situation right now where a team that struggled to get to the top over 21 years is now looking good for the title, but does have a history of also panicking and becoming a bit perhaps arrogant and not fighting the way that they need to all the way through to the end. You're sitting with another team in that of Liverpool, who started off the season so well, and off the back of last season, you would think to yourself, there's no ways they aren't gonna win. And then you have Man City, who has the Pep Guardiola effect, who was winning everything, but now can't seem to get out of bridesmaid sort of space. And then you've got Man United, which is the shining light of football in the world for as long as I can remember growing up, with the odd interlude of other people butting into their space, and they just can't seem to get anything right these days. Is that similar to investing? At the end of the day, it's about psychology. It's about attacking everything with confidence, and confidence comes from knowing your game, practicing, researching, and so on. And the reason I want to talk a bit about that today, before we talk about the markets over this month and so on, but it's because we spoke last time about life companies and asset management companies within a larger life company or a banking group, and how historically they've tended to struggle. It's not so much these days, because I think lessons have been learned, but historically they've tended to struggle. So maybe I can start off the question with you. Why do you think that is the case? Why do you think that there was a difficulty for life companies to be successful in the asset management space, specifically given that you're part of a life company?
Yeah, I think spot on. And I think your football analogy does play in nicely here, where I think sometimes certain asset management houses are slow to respond to changes in the way that the sport is being played effectively, where you fail to acknowledge that things have changed, the rules have changed, the actual landscape is a bit different. And I think that's the space that some life insurance or life insurers found themselves in as the kind of 90s and 2000s dawned on them, and all of a sudden there were lots of independent asset managers, the rise of the unit trust, very different way of doing business, and some responded more slowly than others. I think you're correct. I think that asset managers have learned to adapt to it or die, and you just have to make sure that you are able to leverage off the benefits in different spaces. In much the same way, in a football team, you need to learn how to play the field at that particular point in time. So it's really, I think, a situation where you need to keep an eye out for that signal, ignore the noise in the short term, but really understand the signal of what markets are trying to tell you.
So if you try to draw analogies, I'd say that Manchester City, that sort of came from nowhere. They had a bit of a legacy, but they came from nowhere, started winning titles. That's almost like the Coronations and 91s. There was some substance there, but they came through the ranks and they overtook others within the market. A Liverpool is almost, I hate to say it, a little bit like an Alan Gray, who stuck to their knitting all the way through. It hasn't always paid off for them, but ultimately they have experienced success, but it can sometimes be up and down. And, are they going to succeed or aren't they going to succeed? I'm not certain who Man United is at the moment. So I think I'm just going to leave that one out. But for the sake of my boss, David, he supports Tottenham. So I think Tottenham's more like the soon-to-be relegated and fall out of the surveys type team who's chasing every bit of success that they can and never achieving it. But that's just for his benefit. But Arsenal is the team that strikes me as being the team that has plugged away, stuck to their knitting, has felt disappointments, but has had to learn from all of that, and slowly but surely, incrementally, has been developing. And if you bring it back to the discussion around the insurers, so back in the 90s, the insurance companies were dominant. That was the natural place to have your money managed.
Yeah.
And because of, I suppose, a bit of lack of competition, there was some naughtiness amongst those insurers. They would have strategic assets and so on placed within their portfolio, so the properties they owned and so on. And that would cause sometimes a bit of performance drag. And they didn't keep up with the trends. They didn't see the Manchester Cities coming along, the Coros and 91, and those guys ultimately took over. But if I now look at the Stanlibs and the Omigs, it's a bit Arsenal to me. So they've realized that, and now they've had to, define their disciplines, and they're sticking to those disciplines quite strictly, and that is starting to pay off. They're starting to come back into the reckoning, if I could put it that way. And I use the experience I had when I was part of a life insurance group where I sat at board level, where the board members were the ones who created the performance problems, because they had a short-term mentality. They were worried about their biannual results. So they wanted stronger performance on the life company's assets. And that they put pressure on the investment team of the asset management company, who started chasing their own tail, trying to find that performance in the short term, and never stuck to their philosophy, stuck to the processes that they were meant to, stuck to their beliefs. And that's ultimately hurt their performance as they started chasing their tail, Tottenham style, if I could put it that way. So I'm pulling out all of the analogies today to try to get it right without actually focusing on Man United. So I'm proud of myself. So any reflections in that regard, and the importance of psychology and strength of mind when it comes to the asset management game?
Yeah, spot on. It becomes very difficult for an asset manager to deliver when the asks keep changing and there's conflict in terms of what actually is being sought. And again, let me play off the football analogy. If you're chopping and changing football managers all the time, it's pretty much the same story, where you're trying to chase some kind of legacy, but you're not building off a solid foundation. And those rebuilds can take time and can be painful, because performance, much like football performance, is produced day by day, month by month, year by year. And you can't kind of fix a 5-year underperformance overnight. It takes a full 5 years of performance to do that, and so on and so forth. So it really becomes a matter of businesses standing back and saying, how is it that we can fix this problem, the performance problem, or the philosophy problem, or the perception problem? And you say, how can we do that given the available instruments in the market, which have changed, have broadened, are different? If I think back to 15 years ago, something like passive investing was fairly niche. It was something we said, oh, that's kind of what they do in kind of the US market, or very highly liquid, highly developed markets. And that's grown. Now we have a situation where we were told ETFs were passives. Well, guess what? There's a massive influx of actively managed ETFs available, and increasingly so. And I welcome that. I welcome, the variety of ways in which we can channel money and the right ways will win out in the end. But the reality is that you need to be alive to the fact that the opportunity set has changed and grown enormously in 5, 10, 15, 20 years.
So it's always important to keep up to date with the trends and then try to identify which ones are ones that you believe in and can support that as an investor. But let's bring it back to trustees and advisors making decisions on behalf of, the underlying customer, the members, and so on. So again, back to the football analogy, you mentioned the changing of coaches. You see this happening the whole time. The guys change coaches every how often in order to try to stimulate results, costing them a lot of money every time that they bring in a coach, costing them as a coach leaves and find another one bring in. And then the players that they bought and spent a whole lot of money on don't suit the new coach. Then they have to change the squad. So there's massive cost incurred in that short-termism that there is. So you look at that and you say that's obvious. Why would they do that? Why wouldn't they just stick with the guy and give him time? But they don't. For some reason, there's a psychology. Some perhaps do, like Arsenal went through a tough phase with Arteta and stuck with him. Some guys just can't seem to get over the short-termism in their mindsets. And the similar can happen in the investment markets. If you're trying to chase performance, you can continuously chase performance. And that's why the average investor tends to underperform the average index. Because of the bad decisions they're making in that process. So the chopping and changing, comment on that. And then also I want to ask you the question, can you chop and change if the fundamentals of the business are right? And how those two relate, because I want to come back to talk about Alan Gray a bit.
Okay, sure. So spot on. I think the analogy extends actually perfectly into the space where you consider the fact that trustees, in much the same way that I guess management of large asset management houses and pension funds themselves, the actual institutional investors, are faced with this dilemma of saying, are we actually seeing this signal that there's something fundamentally wrong that we need to act on and change and fire the manager and get a new manager in and buy and sell players? Or is it just noise? Is it reflective of kind of the market conditions that we find ourselves in at a point in time? And as much as we'd love for our football teams to win all the time, it's just not going to happen. And the same thing applies with our managers. They're built to perform under certain conditions in certain ways. And that's why it becomes important to be able, as an asset consultant, to guide a client to say, this is the way we're expecting the manager to perform. And as weird as it can be to sometimes discuss, explain why they did well, and that's actually a warning bell, because that's not the stated philosophy. That's not what they should have done. We expected them to underperform under these kinds of conditions. So that becomes a critical point to consider in your kind of feedback and in your strategy design. Coming back to kind of the question around, chopping and changing when things are good, it's kind of linked to that point to say, if the delivery doesn't suit what you understand and what you're expecting, you need to interrogate that and say, why is that the case? And it forms part of the broader kind of view to say, is this aligned with strategically as a fund where we are trying to go? And it's not just about the kind of call it raw performance, even just the raw risk stats of volatility and drawdowns and all those beautiful measures that we enjoy. But it goes further into saying, does this fundamentally suit the strategic intent of what the fund is trying to do? And for a lot of boards of trustees, that's very difficult and intangible to do. And as an industry, we've got a lot of work to do. And this links to a lot of the discussion that I know EBnet's been driving around kind of private market assets, infrastructure investments, ESG as a broader concept. And that plays into this in interesting ways.
Hiya pals, greetings from Sammy. EBnet is proud to bring you top quality content from experts across the financial services industry in South Africa and internationally for free. Your support helps us in doing this. All we ask that you subscribe to our channel by clicking the subscribe button below. Share this video with others you think will benefit from it. And give us a thumbs up if you are enjoying the content. That way you help us help you. Thank you from the team at EBnet. For more great content, please visit www.ebnet.co.za. Ciao, ciao, and bye-bye.
So I think that there's a fault in, and I'm picking on the investment consultants again. So I don't mean it in a negative way, but I actually mean it more from the perspective of trying to assist and get guys thinking. Because when we as asset consultants go through a process with our pension fund board of trustees, I think sometimes we feel the need to ourselves impress. Right, so we try to make everything positive around the people that we're putting on the table, where I think there's a skill in actually saying, look, these are good managers, but let's set an expectation. Let's talk about what we can expect to see from these managers over time. Is there sufficient difference between them? And to prepare for the times that might not always be good, because not every football team is always going to outperform. I mean, it's just life. That's what it is. So, but we tend to skip over that.
Yeah.
We don't say, well, look, expect these guys can do really badly at times, so be aware of this, but ultimately it pays out. And if you don't have that perspective, when you're then in the situation where they're not doing well, you think like you think you made a bad decision. So now you're chasing your tail in that regard. And I don't think the consultants do enough. And then from a perspective of reporting, we might put in on the table initially for customers that you should expect so much in the way of a drawdown or whatever, but then those numbers disappear in the reporting. And to me, what's also important is to say, let's look back to what we said at the start, and is it panning out in that degree? So I don't think there's enough discipline around the consulting side ultimately of it. And then I'll come back to Alan Gray. So any comments on that?
Yeah, I think what you've said is absolutely right. A good consultant goes back to that construct and revisits it all the time, even when it's actually the easy conversation. And I think I mentioned this a few times over the last couple of episodes, where when markets are running up and JSE's up 31% and we're hitting 115,000, 112,000, and the all bond index is running hard, 2.6% up in November, so far. It's easy to be an asset consultant then, because the rising tide lifts all boats and everyone is smiling about the returns. This is when you need to be having some harder conversations that are otherwise not impossible, but certainly much tougher to do when, returns are depressed. So this is the moment to go and say, look, we actually would have expected manager A to perform differently under these very buoyant market conditions. Perhaps it links to where we're going.
So spot on. And then there's always exceptions to the rule. So we know that high turnover within any IP-based business is going to be a challenge for that business. But I've always found Alan Gray to be an interesting example, because Alan Gray actually has very high turnover. But the reason that, very high turnover is the wrong word. They have turnover. They have decent amount of turnover in that business. But it's almost like I use the term the fatties and monies granny. You bring out the next one. Okay, because they're so well trained all the way from their, call it academy, as the guys come in and learn the ropes on a particular philosophy, to whether they then graduate and get to stay beyond that. They are applying the philosophy the whole time. So for them to have turnover is a case of rather selecting the best, or if someone moves on, it's about the opportunity to now bring up some freshness into the processes and so on. So it's interesting to see that there's always those exceptions, and sometimes people can buck the trend or buck the norm thinking by having other things in place, and hence why research is so important, and the consultant goes and kicks the tires and understands what makes that company tick.
Spot on. And I think let's lean back into your football analogy. It's about saying, are the reserves on the bench up to the grade that if a player gets injured or a player moves on to another team, can you bring in that depth? And It's also about pinpointing exact weaknesses within a house. In some cases, they have got quite a strong setup in one or two asset classes or franchises that they run, and in other spaces, it's critical and dependent on one or two personalities. And I think it's not saying, avoid a house where there is a strong bias and a kind of key performer, but understand what management actions it will call if that person is no longer around, versus in other spaces where one or two of the team move on and you have confidence that there's depth in the squad to keep it running.
So I see the Alan Gray approach, the way that they've set up the business with a defined philosophy and a pipeline of talent that they bring into the business and then develop it and then select essentially who the leaders will be going forward, is actually akin to, so I'm now going to puff my chest out, Man United under Sir Alex Ferguson, because there he spent a lot of time in terms of the academy, a lot of investment into the academy, bringing in young guys, grooming them, not just on the art of football, but on how to grow up and how to behave and how to look after themselves and so on. So he created professionals early on. And then he had his team and he let some really magnificent players go early, the likes of a Roy Keane or whatever, because, maybe they were getting a bit arrogant or whatever it was. David Beckham was another one. And he made profit off the back of that to reinvest in the youth. And he never really spent massive amounts of money going to find new players. The odd one he did to strengthen the squad. But otherwise, there's a philosophy. We stick to our philosophy. And at the end of the day, once that breaks through, when you get that right, then you have longevity, sustainability of results for your customer or your fan base. So everyone always questions, like, what did he do differently? I think that's it. He just had a very clear philosophy. And that, to me, is the secret of asset management. Is that clear philosophy?
I agree. If you can be clear on your philosophy, you can stick to your guns, even if, as you say, the people around it may change, but the philosophy remains intact and that depth of talent remains there. People can build trust, and that's why you have some houses that they might drop lower on the table, but people are still backing them to get back and right back into it.
Yeah, and that philosophy extends beyond valuation driven or growth driven. It's also about how you manage the business. It's about how you develop your people and all the rest. It's all part of that picture. And that's why, again, due diligence of asset managers is critically important, because if you get that understanding, it can be the difference between a couple of percentage points in the way of return at the end of the day.
Exactly. And it talks to the fact that your trigger points on different managers in your lineup might look very different from each other. So the thing that would kind of trigger you to review or to act or to sell might look different for manager A than to manager B because of certain kind of key weaknesses or key concern points that differ between the managers, as well as the fact that you have different managers in for different reasons.
And just like the human psychology leads these clubs to hire and fire managers constantly costing themselves a fortune of money, a similar thing, regardless of us knowing, happens in investments. We still chase the top performers regardless. It's too tempting to want to go there. Now, reasons that investors underperform the indexes often is because they have chased everyone at the top, everyone groups together, then their performance drops off, so now things look bad, so make changes, and it's at the wrong time. So that talks to the importance of diversification, and a consultant playing the role to say, I'm putting forward this manager over here, his performance isn't the best, but we like him for the following reasons. And that's going to be, if you can keep it, well blended, that's risk management at the end of the day. So risk management is not just about the numbers, but it's about how do you manage the client's psychology and actions that they're going to want to take off the back of it.
Spot on. I mean, Leon, take it to its logical extreme, and perhaps it's an oversimplified example. If you would, and remember, we look at kind of survey tables and past performance on exactly that basis. It's historic. If you just looked at the Premier League table in 2022 and said, okay, City have won 2 years in a row, I'm putting all my money on City. Yes, you would have won in 2023, but you wouldn't have in 2024. You then say, okay, I'm putting all my money on Liverpool because they won the league last year. Certainly as it stands today, it doesn't look very promising for you if you made that call. So it's about properly kicking the tires and not simply relying and saying somebody delivered over the past year or two or three. to get the outcome.
Yeah, look, I think it's an interesting conversation. The reason I wanted to have it is just to show how much of success is psychology driven in some way, and the best way to manage psychology is through proper research, proper consideration, proper planning, setting of expectations. And that's the role of a financial advisor, of a consultant, and of a trustee at the end of the day, is to expect that from their providers. And that's where you earn your money. That's the reality.
Spot on.
So I haven't been watching the markets much this month because it's actually not natural for me to watch the markets the whole time. But every day I do get an update, and the update's either green or red on this whole little chart that gets sent through. So I've been seeing a lot more red, and I'll be honest with you, I was quite surprised because I went specifically last night to have a look at the months to date performance through to the end of, not last night, the night before, and there we were up another 2.8% again. And I was like, I just can't believe this. I was expecting it to perhaps even be in the red, but then we did have a red day yesterday, so it dropped down to another 1.5% or so up for the month. So the markets continue to keep going. Now the reality is we've had some really positive news this month. I mean, the ratings upgrades been fantastic. The interest rate cuts been fantastic. We came with the grey listing issued whenever that took place. The only negative that we're sitting with right now is the relations with the US and trade relations and how they could impact growth. But I sense there's a bit of a tide turning against the US on that one. So we'll see where that ultimately all goes. But these markets continue to jump up. In fact, I wanted to show you this in the viewers. So if you go to the EBnet landing page, so the home page for EBnet, can you see it on screen, John?
Yes, I can.
So if you then go down, you'll see towards the bottom of the page, we have a markets update sort of ticker that is sponsored by 91. There it is over there, which is market prices, pretty much 15 minutes delayed. So I just need to refresh this.
Another green day there.
There we go. So there's the indices. So you can see another green day coming through. So it looks like we're going to end up, if the day continues, over 2% up. But you can also get the currencies, the commodities, and so on through this. So it's interesting to just see how the markets are remaining so resilient despite the valuation levels that we're getting to. And I keep on wondering when we're going to have a Snot and Trana episode, as we sit here saying, oh, how bad it looks now, kind of thing, because it's starting to feel like it's getting there, but it's definitely getting there, because it can't keep on going up forever.
Yeah, and I think I mentioned it earlier, it kind of gets to that point, and we've spoken about fear and greed before. There's a lot of greed about, because there's only kind of good news in the markets, but to your point, there are some economic fundamental headwinds that we need to consider. But yeah, the party unfortunately can't go on forever, but yeah, it takes a brave person to call it.
While the party is going on for everyone in true Man United form, my Bitcoin ain't doing so good. So that's come off quite heavily, which is a bit disappointing.
Yeah, it's down almost 30% as we speak from its peaks. Yeah,
but it's okay; it will go back up. So do not worry. Just stick to your knitting. The good old boring John advice. So John, next year we're all off on holiday now shortly, and then next year we'll be getting together to record again Living Markets with Liberty every month in 2026, and we'll be releasing to the market on the first Monday of every month, starting in February, but we will do one later in January as well. I just wanted to mention that because the couple of things. So first of all, these episodes are all now available on YouTube, Apple Podcasts, and Spotify. So people can listen to them while traveling to work or traveling wherever they would like. They can download to their device and so on. So all of that functionality is now there. And if they want to receive reminders on when we publish new episodes, they can go to our EBnet stream page. So let me quickly show everyone. So quickly go back to the EBnet site. Just let me know when you can see it.
Yeah, I can see it.
So you'll see the tab at the top for EBnet Stream. If you go there, you'll see a list of all of the series that we are recording, and we're adding 2 more next year, one on private markets and the other one on the asset climate index. You'll see over here, there's Living Markets with Liberty. If you want to watch any historic episodes, you can just click on view the full series and you'll find all of the episodes in the series. This will always just be the latest 3. And then you can click on subscribe and register your interest, which means you'll receive a WhatsApp on the day of publication so that you don't miss an episode. So you just come in here, fill out the form, provide us with the details, and click submit. So just trying to make sure that people have easy access ultimately to the episodes and so on. So just to the viewers, if they want to subscribe, please do that. We promise we're not going to send you a lot of other stuff. It'll just be the publication date of the particular podcast.
Excellent.
John, I'm going to wish you all the best for the holidays. If you're traveling, please go safely. I need you next year. So we'll have to come up with other interesting topics to relate our art to. And I've got a couple of ideas in that regard, but we will talk shortly about that.
Look forward to it. Thanks, Leon.
Yeah, all the best. Keep well.
Bye-bye.
Ciao.
At Liberty Corporate Benefits, we believe that better benefits are better for business. That's why our holistic employee benefits give your employees financial security and lifestyle stability, freeing them up to be their best selves at work. With satisfied, engaged employees, productivity shoots up, workplace errors and loss decrease, absenteeism and presenteeism are reduced, and you attract and retain the best and brightest talent. After all, if you take care of your people, they'll take care of your business. Our brilliant basics are the non-negotiables that explain why more companies choose us than any other for employee benefits. Our employee benefits are easy and flexible, personal and relevant, and resource-backed, with investment solutions designed to help your employees retire comfortably. Comprehensive cover that protects your employees and their families. Financial literacy initiatives to help your employees make the most of their money. And a range of value-added services for holistic care and support. We make it easy to take care of your people and prove that employee benefits can also be employer benefits. Speak to us about getting the benefit advantage. Liberty Corporate Benefits.